You've probably heard the term transfer pricing thrown around in the news, right? It always seems to pop up with stories about huge multinational companies and taxes. But what does it actually mean? It can feel a little murky. Well, today, we're going to clear all that up. So let's start with a kind of wild question. What if a company could basically just decide how much profit it was going to report in any country it operated in? I mean, just think about that. That's pretty much the core problem that transfer pricing is trying to solve. And look, this is not some small academic thing. We are talking about a mechanism that literally moves billions of dollars across international borders every single day. It has a massive impact on how much tax money a country gets. All right, so let's get down to it. What in the world is transfer pricing? Okay, in simple terms, transfer pricing is all about the price tag on stuff sold inside the same company. Think of a big corporation like a family. When one part of the family, say the parent company in Germany, sells something to another part, like its subsidiary in India, the price they agree on is the transfer price. To really get a grip on this, you've got to see it in action. Let's walk through an example of how one simple price tag can shift huge amounts of profit and taxes. Okay, so here's our setup. We've got H Limited, a car company in India, where the corporate tax rate is a pretty hefty 30%. Then you've got their subsidiary, S Limited, which is based in Switzerland, where the tax rate is a much friendlier 12%. And the car they're making in India costs 8 lakh rupees to build. So watch what happens. First, the Indian company, H Limited, sells the car to its own sister company in Switzerland for 10 lakh rupees. Since it cost 8 lakh to make, they only report a profit of 2 lakh in high-tax India. That means they only pay 60,000 rupees in Indian tax. But then, the Swiss company turns around and sells that same car to the final customer for 20 lakh. A huge chunk of the profit is now officially made in low-tax Switzerland. See what they did there? But what if H Limited had to sell that car to a totally random, unrelated company? Well, they'd have to sell it for the fair market price, right? Let's say that's 15 lakh rupees. All of a sudden, the profit made in India shoots up to 7 lakh, and the tax paid in India jumps to 210,000 rupees. That's a huge difference for the Indian government. Now let's just put the total tax bills side by side. In that first scenario where they sell it cheap internally, the company's total tax bill across both countries is 1,080,000 rupees. But in the fair market scenario, it's 2,070,000. For the company's bottom line, it's kind of a no-brainer which one they prefer. And there it is. That 90,000 rupee difference on every single car is tax revenue that gets shifted from one country to another. This is the whole game. A company wants to legally pay as little tax as possible, but every country feels like it deserves its fair slice of the pie. So obviously, governments aren't just going to sit back and let this happen. So how do they fight it? They use this simple but really powerful idea called the arm's length rule. You know, the logic here is pretty simple. The rule says you have to price a deal with your own subsidiary as if you were dealing with a total stranger. You're supposed to keep them at arm's length. The price has to be what two independent companies would actually agree to on the open market. And here's how that works in the real world. Say an Indian IT company bills its American parent company 100 lakh for some services, but the tax authorities do some digging and find out that for the exact same service, the Indian company charges outside clients 130 lakh. Well, guess what? They can just add that missing 30 lakh right back onto the Indian company's income for tax purposes. Gotcha. So as you can probably tell, companies can't just wing it and hope for the best. There is a very formal, very detailed process they have to follow to stay on the right side of the law. Yeah, it's a whole thing. Companies have to list every single one of these internal cross-border deals. Then they have to do this deep analysis called a FAR analysis of what each entity actually does. What are its functions? What assets does it have? And what risks does it take? Based on all that, they use one of several approved methods to land on a fair price. And they have to document every single step. And I mean, this is real. This isn't just theory. This is a world of hard deadlines and official government forms. This right here is an actual filing deadline in India for a report an accountant has to sign off on. It's a serious business. Okay, so what happens if a company gets this wrong or decides not to play by the rules? Well, the penalties for non-compliance are steep. Let's start with the basics. If you just fail to keep the right paperwork or you can't produce it when the tax authorities ask for it, that's an automatic penalty of 2% of the total value of that deal. On a big transaction, that can be a ton of money for just a paperwork mistake. And remember that accountant's report we just talked about? If you just flat out fail to file it on time, that's a penalty of 100,000 rupees. They do not mess around with these deadlines. But this is the big one. If the government decides you deliberately misreported your income, that you are trying to cheat the system, the penalty can be a mind-blowing 200% of the tax you tried to avoid. That's not just paying what you owe, that's a massive fine designed to make sure you never, ever do it again. So you see, transfer pricing isn't just some boring accounting term. It's really a battleground in our global economy. It's this constant tug of war between companies trying to be efficient and governments trying to collect what they see as their fair share. And it leaves us with this huge lingering question. In a world where business is so interconnected, how can we ever really be sure that the price is right?